Hello, YouTube. This week we're going to find out who is in control, the bears or the downtrend or the bulls or the uptrend. This is going to be very important because I think that both sides, the bulls and the bears, can both say that there is evidence to support their thesis. The bears are going to say that we got a hard rejection at the 50 moving average and we were not able to break the downtrend. The bulls are going to say that we are birthing a new bull market and we are backing off after having our hottest win streak going back to November. So we had 4 back-to-back green weeks, which we can note here, which we've not seen going all the way back to 2021, back in November here. So we have 4 up weeks in a row, and that is the hottest streak. So what's going to be very interesting is whether or not the bears are able to take control, because we're currently at the low of the week with a perfect rejection here at the 50 moving average, which tells us that if this does not get reclaimed the next, I would call it roughly 2 weeks, this could be it. It could be it because the market is now right back to neutral, where we're finding that we spend a lot of time in fear. Those fears have now subsided. We climbed the wall of worry. We got briefly into greed beginning of this week. Now we're right back to the middle at 51, or deadlocked on neutral. And with $2.1 trillion expiring, I think we can explain part of the move on Friday. However, we cannot explain all of it. So just trying to get this out of the way before we look at a couple of charts. Here we can note that there was $2.1 trillion expiring on Friday. I would also note that off of the June lows, we now have $7 trillion in market cap has been created. So from the S&P going from roughly 360 to roughly 420s, that is a $7 trillion appreciation, which means that we've added on a lot of profit. The people who were, again, able to buy the lows are now sitting on a fat cushion of profit. We're going to talk about that this week. We're going to show you how, if we do reject off of the 50 moving average, what targets we want to be mindful of. But more importantly, is this week a week to take moves, or is it a week to dial back, assess, and then react to the moves? So I think we have a great show for you this week. If you wouldn't mind smashing the thumbs up and dropping me a comment, I would greatly appreciate that. So following up on the story regarding the options expiry, if we look at the last 30 days, or when these options went from, again, mostly being bought to now expiring, we can note that the options that retail likes buying the most are Microsoft, Apple, Google, Amazon, Tesla, all bright green. 13% for Apple, 10% for Microsoft, 20% for Tesla, 16% for Amazon. So that tells me that if people were buying a lot of options, again, a lot of single names is roughly 430 billion. Part of the reason for the stomp into Friday could just be that they don't want to pay out more than necessary. So they fade them into Friday to avoid paying out. And that is important because now, as we look at the weekly chart, we're right here at the low. So if we mentioned before that closing near the high of the week was the pressure building up for there to be more continuation higher, like we saw in the last 4 weeks, could this be the start of a bear trend where now closing at the low of the week is going to lead to more downside? I'm not entirely sure. So as we go through this week, there's a few important things to be mindful of. Why would we be bull and why would we be bear? The Fed pivot, the shallow recession, we're over the 50-day moving average. The 200 DMA and 50 weekly moving average are in sight, but rejected at least initially. The bearish case is that the 50 weekly moving average is going to be a rejection. DXY and TNX breakouts, 454 unpenetrable fortress. We have a deep recession risk. This could be a deep global recession risk. Tara, or there are reasonable alternatives, and then Jackson Hole. So if we look at the key dates that drive this week, we note that it's a pretty light data week. We got Thursday, which kicks off Jackson Hole day 1. We got GDP and initial jobless claims on Thursday pre-market. And then on Friday, we got Jackson Hole day 2, and we got core CPI coming out on Friday, remembering that this is the Fed's most important inflation gauge. And then 90 minutes later, we're going to have Jerome Powell delivering his speech at Jackson Hole. This is going to be so important. And one more thing to look at is just going to be the psychology of where we are right now. So we mentioned that the market is largely at neutral, which means that bears and bulls are roughly equally positioned. So as we look forward to Jackson Hole on Friday and Jerome Powell's speech, the market is waiting. It is waiting to see whether or not Jerome is going to hurt us or help us. So now we're going to go through and just briefly touch on the bull and bear scenarios, and then we're going to go through to provide additional evidence to try to build our case to know whether or not the bears or the bulls are picking up steam. So we're going to look here to the bear case first, just because, again, we got a rejection off of the 50 weekly moving average. We are solidly trending down. And this is really, really ominous of what happened in 2000 and 2008. There is a caveat here to saying that in 2000 and 2008, we did have deep recessions. However, the only thing that's for sure is that nothing is for sure. So what we're going to talk about here is going to be, let's go back to where we are now just to get a frame of reference. So here we're going to be looking at what I've been mentioning for at least a few months now. We're going to look at the blue line, which is the 50 moving average or the short-term price. And we're going to look at the black line, which is going to be the 200 moving average or the long-term price. Generally speaking, when we hit the 200 MA on the weekly, that is considered the Fed pivot or the Fed put, where they are writing puts. And now as we approach the blue line, we want to find out whether or not the Fed is going to allow us to break higher, or if they're going to come and crash the market again. So now if we go back in time to know whether or not we're going to get a rejection, I notably want to focus here on 2008, but we're going to look at 2000 first. So we're above the blue line, then we lose it. We come down to test the black line, even go lower. We bounce back up, and that is where we fail to reclaim the blue line, or that short-term moving average. Okay, cool. So by not getting back above the blue line, that leads to one nasty cut. We reject on the blue line again, a second nasty cut, and that is the negative 50% from the all-time high. If we now look here to 2008, again, we're solidly above the blue line continuously, then we lose it. We fall below it. We test the 200-day moving average. Then we bounce up, and this is where we would be in the cycle right now in 2022. So after we do not get back above the blue line, what happens? We go down once for a second leg down, and then we have our huge waterfall, which leads us to that negative 50% cut. So now if we understand this and we look back here to, again, we're looking at the blue line. We're now going to go back to today, and we can recognize here that the bear case is pretty much that we've maxed out. We've gotten to the 50 moving average, which is going to be where bears want to reposition, and there's evidence to support that. Shorts are starting to reload, and they've had their best week since March of 2020. So that's the bear case, is that the high is in, we're not going to reclaim it, and now we're going to go lower. We're also here at the low of the week, and that's a really important thing to keep in mind, because now the pressure that was building up to the upside is releasing to the downside. So that is the bear case. The bear case is that we're repeating 2008, whether or not we have the fundamental same reason to do that. The technicals tell us that this is going to be so important. And with Jerome on Friday, he's going to tip us either one way or the other. We have to remember that the last time Jerome spoke, he told us that the summary of economic projections was the most reliable indicator. And we've had a lot of Fed officials come back and walk back the neutral stance. So the 50 weekly moving average rejection is the bear case. I also want to talk about DXY and TNX. These are just two things that, if you're not familiar with what they do, they are extremely important to the way the market functions. And here we can note that the dollar went up by roughly 2.3% this week. I am getting a pretty serious warning here by looking at the monthly chart on DXY that the rest of the world is not doing so great. So if the US is going to remain the best in a bad world, the dollar's likely going to keep going higher. We could go as high as 120. We've now had a retest of 106.56, which is going to be our level going back to 1989, and we're back above it. We have a W or a win on the weekly chart, and we have a golden cross. This is generally going to be a pretty bullish pattern. So are we going to have more continuation? This is its strongest weekly close, going all the way back to, to 2002. So the dollar index has not been stronger since 2002. That is 20 years. That's really important. Now we're going to look at two more things here to get a better sense on, again, TNX. TNX is the 10-year Treasury note. So here we're looking at US 10, which is the same thing. And here we're noting that we are reapproaching the 3% area. So everyone who is bullish has been saying that 3.5% is going to be the peak on the 10-year note. And now that we're reapproaching that 3% area, if we match what the dollar already did by getting to the red line and then closing above it, that is gonna hamper the market rally. It's likely going to lead to downside, and I'm not sure how we're going to overcome this. The bond market has also been leading, which means that it moves first, and the stock market moves second. So the 10-year note right now is flashing a warning. If it reclaims 3%, it's going to be hard for us to continue to go higher. So that's the second important thing. And then the final thing here is just the yield. So the 2-year Treasury note is also at its third highest closing price. It's roughly flat, going all the way back to 2007. Again, 2007, 2008. That's what we just talked about on the weekly chart for SPY. And what's interesting here is that the 2-year note is actually flat on the week, but the 10-year note is dramatically higher, almost 5%. So what does that mean? It means that short-term inflation expectations are roughly neutral, right? They're equal to what they were before. However, long-term expectations are now dramatically higher than they were before. People now expect that the inflation rate for the next 10 years is 5% higher than what we saw just last week. So now we're seeing long-term inflation expectations start to rise. And that is evident here by, again, the 2-10s inversion, where we're now back down to 1.088, or the exact area I've been watching for our all-time high going back to 2000. So if now we have a shooting star here and the yield curve inversion is starting to abate, or again, start to go back down, does that just mean that short-term inflation expectations are now catching up to long-term expectations? Or is this going to lead to downside where the market is topped out? So at a high level, that is the bear scenario for this week. We're not going to get to 454 if we can't even break 430s. And then for the bull case, the bull case here is that we have had the best third quarter since the 1930s. So we've now had the best start to Q3 for 90 years. That's a long time. The Fed pivot means that we've now bounced off of the roughly 200 weekly moving average, and we're right back here to the 50 weekly moving average. All we have to do is rally by an additional roughly 3-4%, and we're going to be there. And again, we have a shallow recession as of right now. We're over the short-term price, and all we have to do is to reclaim that 200 DMA and the 50 weekly moving average. So if now we look over here to a daily chart for SPY, we're going to note that we have a red line here. The red line goes back to 429.66, or the April and May tops. So that's really important, because what we would expect to see is continuation if the bulls are still in control. So when we look back here to our previous period where we've been tracking the coil and the coil shot down, now we're looking at the coil on the right-hand side where we coil up and now we're shooting up. What's really particularly, what's really interesting here is just that we have a dramatic flush down here. Over here, we have a nice squeeze higher, but it's not dramatic. We found resistance right at the 200 DMA and we backed off. So what I'm looking at instead is, what is the price action theme leading up to here? We're right back to the uptrend. We're right around a pink or pivot area, which is going to be 420.76, or our key monthly low. And now we're just not sure. So when we look back to this period here, again, closing at the low, the low, the low, the low, and the candles are just red. Sorry, they're full. Full candles mean that we closed lower than we opened. So when we stopped closing lower than we opened, that is when the bottom started getting carved out. Notably right here on the Fed, that is the Fed pivot. This right here is accumulation. So now, as we look forward to whether or not we're seeing the opposite happen over here, we're starting to see some of that. So what I mean is, after we started our first squeeze higher, we gap and go. This is the only day that we actually closed lower than we opened. Otherwise, we have hollow candles, which means closing higher. So higher, 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 higher. Even though we close red or slightly down, we're closing higher than we opened. And then on Friday, we get our first full candle again, which just means that we're actually closing lower than we opened. So in terms of the bulls, what I want to see is I want to see a bounce first thing on Monday, Tuesday. We cannot afford to stall out. Why? We're resting at the low of the week, right around our January low at 420.76. We saved it by about 50 cents. And if we're not able to bounce in the early part of the week, what it pretty much means is that even a short-term uptrend, like we see here on the hourly chart, is going to be breaking. This here goes all the way back to July 13th, which was, again, right around our lows where we started the big rally. And the arrow right here just signifies that if we are below 420 by the roughly lunch on Tuesday, it means that we're no longer going up. And we note that we're not really going up on the weekly chart anymore. We're going to break the uptrend. So what this means for me is that if there is more downside potential, We're going to find out by Tuesday at lunch. So for the bull case, what we need to do is to hold on into Tuesday, and we need to make sure we do not go below 420. That is pretty much it. So when we go back here to our notes, we talk about why bull or bear. Well, we need to also make progress towards our 200 daily and our 50 weekly. So the flip side of looking at the 50 weekly moving averages being a rejection for the bears, what we want to see from the bulls is that we save that hourly uptrend into Tuesday, and then we make higher highs. I want to see us above that 50 weekly moving average before next Friday. So into the first Friday of September, if we are not above 435, I am getting more and more doubtful this rally is real. One more chart to look at here is going to be the monthly chart. And this just shows us that the reason why this is also important is because we also have our monthly downtrend here. Our monthly downtrend also corresponds with 428, which is going to be a quarterly base. So if we are not above 430 going into the first week of September, what that means is that we're not going to be breaking this downtrend on the monthly or on the weekly. It means that this is a rejection from the monthly top that we had here back to May, as we showed you on the daily chart. And now we're likely going to fade back down to about 400 and test the uptrend, coil up, and then we decide what we're going to do. I think there's roughly a 50-50 chance that we get either or. I don't know who's in control. So for this week, for me personally, I am opting for safety, right? I want to be safe. I don't want to be out there, right, trying to predict where everything's going to go. I would rather react than predict. So at a high level, that is pretty much what we're watching here. I want to go through a couple more charts, and we're going to keep the story going here. So let's go here. And again, if you're watching the stream, I would really appreciate a thumbs up. To try to tell my story in a different way, I'm going to pull up an article here from Bloomberg, which was published on Friday. And this is published just after the market close. So rowdy summer stock bulls catching the scent of an autumn reaping. I expect September to be volatile. S&P tends to decline 1% on average during the month. So I've taken some excerpts out of this article to try to explain it. But here we go. All right. I think I actually just want to start right here. So the stock market could surge another 12% through the end of the year as more than 100 billion pours into equity funds. This is from JP Morgan. So what JP Morgan is talking about is that if we're able to break above the key area and go higher, there's going to be people who are going to catch up and start to buy the market because they are underperforming. But we need to get above this 430 area for them to want to get in. And on the flip side, now we got Bank of America saying that stocks are in the midst of a classic bear market rally, and the lows haven't been seen, says Bank of America. So these are two pretty big banks, Bank of America, JP Morgan, giving you the exact opposite view. And that is part of the reason why we're finding a neutral stance in the market right now, because for every bull, there's a bear to offset it. So I don't know who's right. And these are big banks. They're smarter than I am. So when they're both giving us very different outcomes here, where we rally 12% to get to basically the high of the year at 4,800, or that we break through the lows of the year, that gets me a little bit worried. So again, we're right back here to neutral. We can also note what is driving inflation, and this will be particularly important as we pay attention to Jackson Hole. But now we're going to look here at the rowdy summer stock market bulls catching the scent of an autumn reaping. A decision looms for stock investors everywhere. Sit quietly and pray your dumb luck compounds, or take the money and run in case a summer's silly season gives way to a crash of 2022. So we're now going to read a couple of excerpts here. For those who are still long, Friday brought chilly tidings. Big drops in the S&P and NASDAQ 100 indexes. A meme stock dump. Data from Wall Street trading shops showing hedge funds were warming up to their shorts again, and that those shorts were making money. A basket of trading bearish speculator favorites slid more than 6%, bringing its weekly drop to the most since March of 2020. What does that mean? Bears are starting to make money again. And on the flip side here, the pressure to figure out soon is high after a $7 trillion rally broke out in the middle of the Federal Reserve's stiffest rate hiking campaign in a generation. Feeding arguments to let the stock bets ride are solid earnings and chart patterns suggesting the gains may last, including the S&P erasing half of its bear market losses, a feat with an improbable sound record of success. So what that means is that if we snap a Fibonacci retracement in here, we go from the peak down to the trough, we've reclaimed the 50% retracement. The 50% retracement is 421.28, basically right where we are right now at 422. So maybe now you understand the reasons why the low of the week is 421.22. It's like exactly a back test of that 50% retracement from the high. You got it. So for the bulls, we cannot afford to go down. This emphasizes the urgency for the bulls to continue to march us higher first thing at the beginning of next week. As we look here too, most shorted stocks tumble, giving bears their best week since March of 2020. Bed Bath & Beyond, AMC, GME, etc. I expect September to be volatile. Yeah, me too. But the bad news is that any mispricings can be corrected quickly. As you probably saw, Bed Bath & Beyond took a waterfall fast. So we look here at Bed Bath & Beyond. Not that I love tracking the stock, but oh my goodness. In 1 week, it went down by 65%. Yep. That is a very efficient and violent mispricing. It happened quickly. Not only is September the month where the S&P with the worst S&P 500 average performance, it's also the only month where stocks fall more frequently than they rise. So what does this mean? It means that the theme we've been noticing here on the daily chart is likely going to reverse. We're going to find distribution. Distribution would look the exact opposite of what we see over here. Again, over here we have largely higher closes than opens, which means that we have hollow candles. And now we note that we have the first red bar here. And if we're going to lose our uptrend, that should feed through to more full candles or days where we close lower than we opened. So what this tells us is that on average, the S&P actually falls for more sessions than it does rise. So this is giving us some evidence here for the bear case. Total number of up days versus down days from 1928 to 2022. September being the worst one. I don't think we can say blah, 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 blah. So here's the perfect rally for the fall. And if you notice here, again, we're seeing contradictions within the same article. We're seeing contradictions from bank to bank, and we're seeing contradictions from retail, contradictions in sentiment, which means that we really are at a pivotal point. I know we say this often, but this could not be more important. We're at the 50-yard line. We have an apex being met here. We have key data coming out. And we need to know what is happening in terms of sentiment. I don't think we can say, the fall is always tough. That is less relevant today, he said. If we get a continuation in lower inflation readings, if we have a decent jobs report as far as net new added and not and have some wage growth, but not enough for people to think that will drive inflation, that's the perfect recipe for a fall rally. So what they're talking about is that, again, we note that inflation's been cooling off, and what has been driving inflation needs to cool off as well. So I'll be paying particular attention to what Jerome Powell says on Friday. Moving forward here to our next article. A giant rally. S&P is off to its best start of a third quarter in 9 decades. It goes all the way back to 1930, which was what? The Great Depression. Whoa, probably didn't know that. All right, moving forward. Here is the flip side. I would expect the Fed to play a big role if we get a September swoon. Again, we talked about the September swoon being that the monthly chart is going to reject on our downtrend at 428, which is a key area. We're going to fall back below our 50% retracement at 421, and this is going to turn into a big old sour reaction. All right, so bearish traders crushed in the July-August rally are showing signs of life again, and hedge funds, which borrowed stocks to bet on further declines, this week either stopped covering or started reloading on shorts. Separate prime brokers data from JP Morgan, Chase, and Goldman Sachs shows. Okay. We also have some really important data here. So we got GDP. Again, this is a revision, not really that important. Initial jobless claim, but core PCE is that number to pay attention to on Friday. Also important to note that Jerome Powell is going to be speaking at 10 a.m. on Friday. That is going to be just after that core PCE number, which means Friday is the big day for us to pay attention to. Fed officials in their last meeting saw that there was a need for slower rate hikes at some point. This is from a month ago. Since then, we've heard from all Fed officials talking about how we need to continue hiking into 2023. We also have some potential geopolitical tension where the two people in the world, which are not particularly liked right now, are planning to join a G20 summit in person. I don't know what's going to happen, but it's interesting. A couple more data points here, which are interesting, are just where hedge funds bought in Q2 or the second quarter. Healthcare, consumer staples, energy, and utilities. What is missing? Technology. Right, Soros, we can see what he's been doing. Again, he's buying Amazon, Salesforce, Qualcomm, Tesla. It's just interesting to see the divergence here. Biggest tail risks: inflation, global recession. This is probably a much bigger one. China this week showed that they had to lower their key interest rate by 10 basis points, which means their economy is not doing so great. Hawkish central banks. We'll find out this week. Systemic credit events. I think that might be coming a little bit later. And then a resurgence. We'll find out when. Probably in the fall. Most crowded trades. Long US dollar, long commodities, long cash, long FANG stocks, and short US treasuries. That's also very interesting. Again, also here from Bank of America, investor sentiment remains bearish in August, but no longer apocalyptically bearish on hopes inflation and rate shock end in coming quarters. B of A Global Fund Manager Survey. What's also really interesting is the level here. B of A, again, the bank who says that we're going to crack those lows of the year. Sentiment still bearish. Cash at 5.7%. Too bearish for immediate reversal of bear rally. We remain patient bears. Would fade SPX over 43.28 as rates up, profits down. As rates up, profits down base case. What that means is that they think we're going to go lower. And if we now look here at SPX, what's really interesting is the high that we put this week, 4325. We would fade anything over 4328. That's right where we found that resistance. Is this interesting? I think this is very interesting. So those key dates this week are going to be particularly notable. We can also look here at the wide bull or bear, which we've already talked about. So when Jerome Powell talks on the 26th, we are going to get clear direction. Why? This is going to be on Friday. That's going to be right around our weekly close. We also have to keep in mind that we're going to be getting a new batch of data in roughly a month from today on September 21st. We're going to have a new summary of economic projections. Jerome Powell kept deferring back to the summary when he gave his last press conference, which means that he thinks these numbers are really important. They should be important for you too. If we're not fighting the Fed and they start to say that we're going to be ratcheting up into 2023 again, the market is going to reprice. The 10-year Treasury note we looked at is going to get above 3% and maybe even over that 3.5%. This is also really interesting because, again, the other thing we looked at here in terms of systemic risk, the risk is starting to get higher as we now approach an area where the system usually faces a breaking point. Again, back in the 1980s, back in the late 1980s, in the 2000s, in 2008, and then in 2018. What does this mean? It means every single time we have hit this downtrend, the problem is that we just cannot afford a higher rate of interest. And even only getting to 3.5 means that they think we're going to print a higher high. We've been unable to print a higher high ever since 1980s. So I don't know how we're going to do that. This just means that the US is very indebted and they're only able to tolerate a lower level of interest before something breaks. So what this talks about here is the systemic risk, right? Systemic credit events. That would be something that would come later. I don't think we're far enough down the bear market bear market reversal for us to say there's going to be systemic events, but we're starting to see some. And then finally, one more thing I want to look at here before we look at a couple more charts is just the psychology. So the psychology for the S&P is that, if we look here to our chart, the psychology chart says that we're going to be going back up to 450, but it might not be a straight line up. Might have to consolidate a little before going higher. And when we look here to what's happening in Bitcoin and also in ARK, it's very, very, very interesting because I don't see how we're going to go into a new bull market unless risk assets are going to join the party. So Bitcoin is heading to 25K. This is from July 16th, so roughly a month ago. We can look at the chart. We can look at the psychology here. And what it says is, again, we're roughly getting a capitulation bounce. I'm getting 100% out of the markets. I can't afford to lose more. And then anger. Who shorted the market? Why did the government allow this to happen? What I'm looking at specifically is going to be, let's pull up the Bitcoin chart. Let's look at the 1 week here. So I was looking at this thing roughly the same price we are now, about a month ago. So in the last month, we've rallied up. The challenge is just that as we're now getting closer to, again, the red arrow, we're now going to compare these side by side here. So at roughly 21.3, we're at 21.3. We came all the way back full circle. So at 21.3, I was looking for a move up to 25,000 because that would basically mean that, let me see if I can blow this up here. Open image in new tab. I'm going to zoom in here to the right-hand side. And then I'm just going to draw on here briefly so we can actually just try to understand what I'm trying to say here. So when we come down, right, we go, let me actually change the color as well so it sticks out a little bit more. Let's use cyan. There we go. So we're forming our M. We come all the way down. And if this is just a bear market bounce, we should not get back above 25,000. We're going to come back down, probably find some more support at our key area, bounce around a bit more, and then go down. And then we get the anger. Then we fade a bit more before we ultimately get our reversal. So now keep that curl, the curl being this part right here. We've curled up and now we've backed off. So just keep that in mind as we now look at the Bitcoin chart here. Oh crap, right? Isn't that exactly what happened here? Yep. So we get our big drop, we get our curl, and then we get our rejection. So let's make this line blue so we can do it basically side by side. There's our blue line. Bring it back over to here. Oh, man. So by not getting back above this low, or 25K, we're not going to go higher. That's correct. That's what I think. So this $25,000 area right here is important, not just technically, it's important psychologically. Why? Well, we're still dramatically off our lows. So if the S&P has now gotten more than 50% of its retracement, where's Bitcoin? So from its all-time high back to now, oh man, like 50% is like all the way up here at 43,000. Yeah, we got a lot of work to do, like a lot. And this right here just tells me that I think that maybe this is a bear market bounce, where bear market bounce, we got a high of 25,200. I was looking for 25,300. We couldn't get an extra $100. I don't know how we're going to go higher then. So that's the first thing. Now we're going to look at the second one here, ARK. Oops, sorry, I don't know what happened there. Okay, so now we look at ARK, and that same low that I am watching here is going to be 46.2. Where do we fall below this week? 46.2. Spend a little bit of time above, and now we are right back below. So ARK is going to signify growth stocks, or the stocks that are going to be, again, the highest risk. So if we're going to go risk on for all assets, ARK needs to rally. This is also notable because that 10-year Treasury note had a 5% week, which means growth stocks should not be performing well when that goes up. So Bitcoin and ARK are both flashing the same warning that I heard and saw when we were going to take that first dip down. So this gets me a little bit apprehension, right? Gives me a little bit of apprehension here. And that's what I want to show here. So the psychology is starting to track as well. And it's really hard for me to ignore that. So now as we look here to a couple more key charts, again, the riskiest, the riskiest assets being ARK and Bitcoin are flashing some warnings. What are the big ones doing here? So let's have a look at SPY again one more time. And we're going to note that, again, I think I've kind of beaten this dead horse over and over. We're at the 50-yard line. We got to get over the 50 EMA for the bulls. For the bears, I would say that if we are able to lose the monthly low, so our monthly low here on SPY is going to be 406, 406.82. So if we get a weekly close below 405, I would say that we're back in a bear market. On the flip side, if we can get above 435, I would say we're in a bull market. So by getting above 435, we're breaking the downtrend on the monthly and the weekly. But by falling below 405, it means that we're breaking the psychology chart, and we're probably coming back down to test probably about 380s, if not lower. So that's really the simplest way of looking at SPY. This 50% retracement too, everyone's watching this. Everybody is watching it. So the reason why that's so important is because if we lose the 420.76 low, we are also losing that 0.5 retracement. And our low of the week is 421. We print a weekly lower low, we're probably going to have more downside. And it's notable because the weekly low before that, 410.22. So if we were to crash land to our February low, that's 410.64. We could form a higher low versus the 8th, reverse there, and then build up more steam to potentially go back above the 50 weekly. Again, it's just, this is so important. It's hard for me to emphasize just how important this is. Now, as we looked at QQQ, which again is also having a down week, down by 2.3%, we noted that technology stocks were largely up in the last 30 days, which means call options were getting minted. What the bulls are going to say is, hey, we printed a higher high, we printed a higher low. We're right around 323.14. We closed at 322.86. We're off by about, I don't know, about 30 cents. We're almost in a new bull market, and we've already poked above and closed above last week over 327, which is our negative 20 off the high. So technically, last week, the NASDAQ or QQQ exited bear market territory and birthed a new bull market. What is missing is SPY joining the party. So for QQQ, we have to fall back below 300 here to confirm we're actually no longer going up. So QQQ is likely going to be very important as a contrast to what is happening with the bond market. We talked about the dollar, talked about the treasury notes. Now we're going to talk about VIX. VIX is up 5% of the week, back above 20. It's been fading consistently. By getting back above 20, it just means that we're expecting that there's going to be more volatility in the next month. So that's starting to get, again, it's been fading consistently since June. We'll see whether or not we can actually catch a bid on it. We talked about I don't know what else we have to talk about here. Let's have a look at the Russell. So I want to look at the Russell because this is also telling us that, again, small caps led the decline. And now, led the decline. They led the rally. So if we're going to be going down again, this will be very important. Why? Well, the relative low, which would also signify the same low we looked at for Bitcoin and also for ARK, is going to be here at roughly 187. If we fall back below 187, that's pretty much my confirmation that we're probably going back down to that bear market. I'm looking at let's actually look at these trillion-dollar companies too, because we have to see whether or not these things are strong or weak. Apple is closer to all-time highs than to its yearly lows. Apple is very strong here. It's really close, within a whisker of getting back to its all-time highs. We're going to go through these in terms of weighting. So Apple is the biggest stock in the market. Microsoft is number 2, rejected at that 50 weekly too, just like QQQ, and just like SPY. What did QQQ do actually? Didn't make it there quite yet. So Microsoft is rejecting off of here. It's trying to go up. We'll have to just watch it closely. Low volume sell-off too. Goog, right? Rejecting on its key low, basically. So it couldn't quite make it up to these lows. All it made it to was to the January low and rejected. So that should actually be a red line now. So we rejected off of this low here. And I'm not sure what's going to happen. Backtesting a big range here. We'll see what it can do. Amazon rejecting off that 50 weekly. So also very notable, and rejecting off relative lows over here, going back to the third quarter of last year. It's got a higher high and a higher low, but it is down 4% on the week. Tesla resting right on, actually about 70 cents above its 50 weekly. This is also invalidating a head and shoulders pattern. And Tesla and Apple have been the strongest market leaders till now. NVIDIA. Still good, still above the green line. Had a 4.6% down week. They report earnings this week, I believe. I'll be paying close attention because NVIDIA is currently the chip leader. And then we got Meta. I don't know if you looked at Meta. Meta is stinky, right? So Meta stinks. It's terrible. Here we go, Meta. Meta stinky. It's terrible. It's at the bottom end of its demand pocket. If it loses 167, it's probably going back down to its yearly lows, if not lower. So at a high level, that is what I'm watching for this next week. Oh, I actually forgot to go through the options chain too. So just in terms of trying to get a little bit more evidence for next week, I'm going to go through this fast, and then we're going to wrap up, and I look forward to seeing you guys next week. So here we're looking at August 22nd, which is going to be for Monday. Let's flip this back to pink because it stands out a little bit better. I'm noticing that we got about 423 down to 420 as being the big area. Where did we close out? Roughly in the middle, 422. On the call side, it's 423 to 425. So 423 would be max pain for me going into Monday, which would imply a whole bunch of nothing. Both sides seem equally motivated too. Just like we're talking with the neutral rating and also with the big banks fighting with each other in terms of where we're going to go. As we look out to Wednesday, here we go, don't save. As we look out here to Wednesday, same areas, right? Roughly 423 to 425. And then up here to 430. On the bear side, we got 423 down to 420 with some here at 416. It's almost the same areas. It's 420 to 425 again. So who's going to win, the bears or the bulls? I don't know. They both seem equally motivated though. Looking forward to next Friday, which generally provides better clues because that's where the weekly closing price is going to be. And again, when we have Jackson Hole and also expiry. So here we have 425 put down to 420 put with open interest that goes down to 415. So still roughly 425 to 420 on the call side. It's 422 up to about 430 with open interest only being at 430. So on this side here, I would give the bears the edge just because they've got the open interest and there's also more volume. Last thing I'm going to look at is going to be the next monthly chain. So I'm going to look at two things here, and I'm actually going to show you the screen that I look at here. Hopefully you can't see my broker information, which I don't want you to. All right, so now we can look here and see that we're looking at the monthly chain on the 16s, which just means the most likely range the S&P is going to trade in. So now I'm going to take that same screenshot like I do before, and I'm going to draw some levels here. So again, what do we have? We got open interest at 430. We got fat open interest over here on the call side at 430. That's the biggest number so far. And then we look here at 425, but really it's 420. So because the 60K at 420 tracks roughly the 60K over here at 430, I would say that this is a call spread where they want it up to 430, but they don't really want it much higher. And that's just because the open interest is what I'm watching here. So for the bulls, they want 430 on the 16s. For the bears, what do they want? Well, they got 430, they got 425, they've got 420 with about 40,000. That's the biggest number so far. And then they got volume and open interest at 415. The bulls would have the edge on this side here. However, there is more of a theme on the bear side when we look beyond the 16s. Beyond the 16s just means that we're going to be looking at all the different expiries. This is going to be interesting because it's going to show us what is happening at levels that are less likely to hit, but people are paying attention to. So when we noted that 430 from before, it's right here at 430. There's not really much that goes much higher. We got some 440. It's muted though, 30,000. They're worth $1. And we got 18,000 in volume. And beyond that, it gets quiet. I got some here at 450, but it's not really that huge when we compare over here to the put side. So we were looking at the biggest stack being here at roughly 420. But now what I'm going to do is we're going to look at 420 down to 400. So I'm going to snap into the screenshot here so you can see it. So here we have 18,000. Over here, what do we have though? Oh God, right? We got volume at 415. We got volume at 410. We got volume at 405. And there's a fat stack here at 400. There's 110,000 here at 400. So the 60,000 stacks that we saw starting at roughly 420 on SPY to go to 430 are matched. Where? At 410, at 405, at 400. These bears really want it. So again, they're motivated. We managed to burn them completely for August. September is usually the month where we close down. So let's see what these bears got. And then when we look below 400, this is where the numbers get bigger again. And these bears just won't quit. This could be insurance. I don't think it is though. I think these are bearish bets. Why? The theme. I'm looking at the theme here. So we look at 400, we look at 390, and we look at 380. The numbers we were already looking at on the chart. You got it. So 100,000 with volume, 100,000 with volume, and then almost 100,000 with volume. That's only down to 380. I'm not going to look beyond that because it gets scary, but what this shows is that both teams are motivated. Who's going to win? I don't know. And I think that if you are very confident one way or the other, what I would really encourage you to do is to understand at what level on the chart you are wrong. If you don't know where you're wrong, they're probably going to hurt you. And I say that because from experience, if you don't know what your pain level is or where you are wrong on the chart, you need to be aware of it now. The market could move massively this next week after we get that post-OPEX release. So again, one more time, losing about 405 is where I think we're back in a bear market. We have to fall back below 405 or lose that monthly low, roughly right here. On the flip side, we have to get to roughly 435 for me to say that we're currently bullish. Until then, I believe we're in a kangaroo market where I am less concerned about trying to predict where we're going to go than to react, be nimble, and ready to adapt as the chart and the data changes. Thank you very much for watching. I look forward to seeing you guys on Monday.